Today, we are going to tackle something that gives every single crypto investor a jolt of anxiety, a market crash. Now, it's definitely a moment of fear, no doubt about it, but as you're about to see, it can also be a moment of some serious opportunity.
So let's just get right into it with the one question that's probably nagging at the back of your mind. Is a crypto crash just around the corner? You know that feeling of dread that just kind of creeps in whenever the market goes sideways?
And look, that fear is totally valid. If you've ever watched your portfolio just nosedive, like 20% in an hour, you know that sinking feeling in your stomach? And without a plan, those losses on your screen can become very, very real.
But here's the good news. You don't have to just sit there and take it. In this explainer, we're going to give you a mental toolkit, a super clear plan for what to do when everyone else is hitting the panic button and the charts are just a sea of red.
Okay, so before we can build a plan, we have to understand what we're up against. Let's start with the why. Why do crypto markets crash in the first place? Let's get a real feel for what this volatility is all about.
This pretty much sums up the crypto world, doesn't it? I mean, we all love it when prices are rocketing to the moon, but we sometimes forget that what goes straight up can come crashing down just as fast, sometimes even faster.
And listen, don't think for a second this is just for some tiny, unheard of altcoins. We're talking about the giants here, Bitcoin and Ethereum. Both have had these massive crashes, wiping out 80% or more of their value in the past. It's just a normal, although pretty painful, part of the crypto market cycle.
So what kicks off these sudden drops? Well, it's usually a combination of things. First, you get this widespread fear, what everyone in the space calls FUD. That's fear, uncertainty, and doubt. Then you might have the whales, those big-time investors, deciding to sell off huge amounts. And then you just add a little bit of breaking news or some surprise government regulation, and bam, you've got yourself a flash crash.
All right, so now we get the why. Let's talk about the what not to do. Because we're about to focus on the single biggest, most expensive mistake that almost everyone makes. The panic selling mistake.
Right here. This is the moment where things go so wrong for so many people. When everything is pure chaos in the market, there is one critical mistake that is responsible for almost all the money that gets lost. And that mistake is
letting your emotions grab the steering wheel. Our brains are literally wired to run away from danger. And trust me, a screen full of red candles feels very dangerous. It's this one emotional reaction that causes people to lock in their losses forever.
We call it panic selling. It's when you slam that sell button, not because it's part of your strategy, but purely out of fear. You're just trying to make the pain stop, but what you're actually doing is turning a temporary paper loss into a permanent, real one, which, you guessed it, almost always leads to massive regret later on.
So, if panic selling is what we're not supposed to do, what should we be doing? Let's take a look at what the smart, seasoned investors are up to and how they completely reframe a crisis into an opportunity.
Okay, you ready for the secret? It's actually super simple. Smart investors, they just do the complete opposite of what the panicked crowd is doing. While everyone else is rushing for the exits, they are calmly looking at the whole situation, not with fear, but with a sense of opportunity.
So let's actually make this real. What does that strategic lens look like in practice? Here is a simple, step-by-step game plan that you can pull out the next time the market gets really ugly.
It really just boils down to these 3 simple steps. First, stay calm. I'm serious. Close the app, go for a walk, do whatever you need to do. No one ever makes a good decision when they're in a total panic. Which naturally leads to step 2, don't sell. Just resist that urge. And then finally, once you've calmed down, you can move on to step 3. Start looking at the crash not as a disaster, but as a potential sale.
And what exactly is that opportunity? Well, it's a phrase you've definitely heard before. Buying the dip. It's the strategy of buying an asset after its price is tanked, because you see that lower price not as a failure, but as a discount. Everything is on sale.
So what does this look like for real? Well, instead of selling, smart investors use these dips to buy more of the projects they believe in for the long haul. Think of a project like Solana, something with a real use case, a ton of developers building on it, and a strong community. The thinking is pretty simple. The projects with real, solid value are the ones most likely to bounce back hard once the panic is over.
Okay, buying the dip is a fantastic strategy to have in your back pocket for when a crash is already happening. But what if we could set ourselves up with a plan that makes these crashes way less scary to begin with? That's where having a proactive, long-term approach really shines.
And the core of this proactive strategy is something called DCA, or dollar cost averaging. It is such a simple but incredibly powerful idea.
All you do is invest a set amount of money on a regular schedule, like say, every Friday, no matter if the price is up, down, or sideways.
And the absolute beauty of this is that it takes all the stress and guesswork out of it. You are not trying to be some kind of genius who can perfectly time the top and bottom of the market, because guess what? Nobody can do that consistently, not even the pros. With DCA, you're taking timing completely out of the equation.
And just look at the difference this makes in your risk profile. Trying to time the market is a super high-stress, high-risk gamble. But DCA? It's a calm, methodical approach that evens out all the crazy price swings and dramatically cuts down your risk over time.
So what's the bottom line here? By just being consistent and taking emotion out of the picture, DCA helps you do what every investor wants. It lowers your overall risk while actually increasing your potential for profit in the long run.
All right, let's wrap this all up. If you remember nothing else from this, remember these 3 things. Number 1, get a grip on your emotions and do not panic. Number 2, zoom out and think long-term. Crypto is a marathon, not a 100-meter dash. And third, use a smart, automated strategy like dollar-cost averaging to put your success on autopilot.
So there you have it. You have the framework. You have the tools. This isn't just some abstract theory. It's a real plan you can use. So the only question left, and it's the one that really counts, is this. The next time the market is crashing and everyone around you is freaking out, are you going to be selling with the crowd? Or are you going to be buying the opportunity?